Vanguard index funds are not created equal, so which Vanguard index funds should you be buying in 2026? In this video, we're sharing 14 of the Vanguard index funds that I have in my portfolio. I am reviewing the Vanguard index fund performance from 2020 to 2025. So that's 6 years of performance. I'll be ranking the index funds for the best performers in my portfolio, the charges that are from these index funds, and then I'll be also sharing the actions that I'm going to be taking based on the performance of these index funds. So what funds am I going to keep? Which ones am I selling off? And which ones am I going to buy more of? It's important that if you're not confident or sure about making any money decisions around your investments, you do not take action without contacting a financial advisor. We are long-term investors, but I think there's nothing wrong with doing a yearly performance review on the index funds because they're not all created equal. It's also so important to make sure you have a diversified portfolio because it's not just about investing in one basket of index funds. It's so important to think of geographical location and also the sectors that we invest in. So that's our perspective. So we're going to dive into the index funds and let's see how they have performed over the last 6 years. So the first one that we're going to look at is the S&P 500. So the charges of S&P 500 is 0.07%. The average return was 16.05%. Of course, the S&P 500 had a very negative 2022. So this illustrates why you need to be a long-term investor, where you invest for the long haul, because if you had taken your money out and panicked in 2022, you'd have missed out on the gains in 2023, where it gave a return of 25.9, obviously in 2024, and where it recovered. So this is the average return over the last 6 years. Okay. So the next fund that we'll look at is the Developed Asia Pacific ex Japan. The charge is 0.15%. It also had negative return in 2022, but look at 2025. This fund has got a whopping 40.9% return, but the average for over the last 6 years is 8.87, because you can see in 2021 it only gave you a return of 1% and then a negative again in 2024. So a couple of years of negative return, but you can imagine how this is impacting portfolios. It's amazing. Okay, so let's look at the next fund. So All World High Dividend ETF. So the charge on this one is 0.29%. So this is quite a high charge in my opinion. So let's just put something there. Okay. In 2020, it was negative 0.3, again in 2022, but the average in over the last 6 years is 9.86% as a return. 2025 was a good bumper year, and you can see that it actually gave a return that was better than the S&P 500. Okay, next one is the FTSE 100. So the charge on that one is 0.09%. In 2020, it suffered minus 11.6, but since then, it has given a positive return. Even in 2022, where most of the index funds were negative, the FTSE 100 was able to maintain a positive return. And that's probably due to the companies that make up the FTSE 100. They serve the British public. So whilst the UK is not a popular sector in terms of investments, you can see even investing in the FTSE 100 does give great returns. So if you look at 2025, the return was 25.7%, which was even higher than the S&P 500. So the average for the FTSE 100 was 9.05%. Right. Next is emerging markets. The charge is 0.17%. As you can see, the average for this fund was 7% because it suffered 2 consecutive negative years here. So if you had locked in these losses, you would have probably not recouped your money. But it is where things are bound to happen, in emerging markets, I believe. And maybe we'll share a video around what is happening in emerging markets. Okay, the next one is developed Europe. The charge is 0.14. The average return on this fund is 9.96%. Even Europe did better than the S&P 500. You can see here at 24.2% in 2025. And also, I think the fall in 2022 was less than the S&P 500. Okay, next one, All World ETF. This ETF still had a negative return in 2022, but the average is overall 13% over the last 6 years. You can see that it's still performing better than the S&P 500 in 2025. Then the next one, Developed World ETF, VHVG. So the charge on this is 0.12%. This has an average return of 13.88%. It has given fantastic returns over the last 6 years, although obviously in 2022 it was also affected. Then the next one is Life Strategy 100. So the charge on this is quite high, 0.2%. You can look at the average returns. It is actually 11.07%. So this was less than the S&P 500 in 2025. Right, next one is the Developed World ex-UK Index Fund. The charge on this is 0.14. The average return is sitting at 13.2%, which is quite decent over the last 6 years. The performance in 2025, however, was not as good as some of these other funds where others are all in the 20s and here floundering at 13.5. Okay, so the next one is the FTSE 250. The charge on this is 0.1%. The average return for the FTSE 250 is 3.82%, which is not very good. You can see that it had 2 years here in 2020 and 2022. But whereas in, where the S&P 500 was giving 25.9, the FTSE was only at 7.9. So it is not as good as other index funds. Right, the next one is Target Retirement 2035. The charge on this is quite high at 0.24%. The average return over the last 6 years was 7.25%. So this is almost half of, more than half of the S&P 500. It is something that most people think, okay, if I'm going to be a lazy investor, I'm just going to put my money in a target retirement fund, think about the time when I want to retire. But you can see if you did that, where you just put your money into a target retirement fund, let's say if you're thinking 2035, you can see that you'd end up with a return of 7.25% over the last 6 years, whereas some people are getting a little bit more than that. Okay, so the next one is the Pacific X Japan. So the charge on this is 0.16%. This fund has actually given positive returns over the last 6 years consistently, even in 2022 when everything else was negative. So you can see the FTSE 100 here was positive, as well as Pacific X Japan. However, look at what's happened in 2023. Everybody else, with the S&P, has a return of 25.9, Pacific X Japan 0.3, and single digits. And so the return on average was 5.53%. Okay, the next one is US equity. So this is the total stock market in the US. The charge is 0.1%. It had a negative return in 2022, but if you compare that with the S&P 500, you can see that that was just half of the losses because of having some buffering from the total stock market. So, but the average, look at what happened in 2025. It gave us a return of 8.7%. Over the last 6 years, the US equity has given a fantastic return of 14.4%. So this is the problem with just thinking, I'll just put my money in the US equity index fund and forget about it. This is what you end up suffering from: a return of 8.7% in 2025, whereas the S&P 500 is sitting at 17.6, and then you've got all these other funds giving better returns. Okay, so as a bonus, I have shared the Fidelity USP index fund. The charge on this is actually 0.06%. It has given positive returns over the last 5 years for this one. I don't have the 2025 performance, but you can see that it does, whilst it tracks the S&P 500, it is not always consistent. It gives you slightly less returns than the S&P 500. This is what's been happening with the Vanguard funds, but I want us to look at maybe 2025. 2025, you can see that the top performing fund was the Developed Asia Pacific X Japan, followed by the All World High Dividend ETF, and then followed by the FTSE 100. We're not here for popularity, we're here and to make our money work. What I want to draw your attention to is these top countries that have done well in 2025. Now, I know that it's all about making America great again, but sadly, that is not the case. So we do want America to be great again so that our investments can grow, because we are all in it together. Look at what the US equity has done. It is the worst performer of all my index funds, of the 14 index funds in 2025, with a return of 8.7%. And the concentration of the best performers, there is a shift here. Asia seems to be dominating 2025. This is where manufacturing is happening. The geopolitical impact of the 2026 is going to have a massive effect on all the markets. So we're yet to see which geographical region has been affected the worst. Even the S&P 500 is sitting in the middle of the screen. when we look at the performance of these index funds in 2025. We're going to look at the performance and ranking the performance of these index funds based on average performance over the last 6 years. So at number 14, we have the FTSE 250, because the average return was only 3.82%. And I'm sure you could have found high interest savings accounts that would have given you more money than this over the last 6 years. At number 13 is the Pacific ex Japan. Now at number 12, we've got emerging markets. Number 11 is Target Retirement 2035. Developed Asia Pacific ex Japan is sitting at number 10. Number 9, we've got the FTSE 100. Then at number 8, we've got Developed Europe. At number 7, we've got the All World High Dividend ETF. Moving on to number 6, we've got Life Strategy 100. Number 5, we've got the All World ETF, revealing number 4, which is Developed World ex-UK Index Fund. This is where the medals are going to come. So in bronze position, number 3, we have the Developed World ETF VHVG with an average return of 13.88%. In second place, we have US equity with an average return of 14.4%. And drum roll for number 1 over the last 6 years, the best return in my portfolio has come from the S&P 500 with an average return of 16.05%. This is why over years and years, a lot of people tell you that if you are just going to put your money somewhere, put it in the S&P 500. Now, past performance is not indicative of future performance. In the next final part, I'm going to be sharing my actions based on the performance of these index funds and ETFs from Vanguard. I've color-coded it to make it easier. So the ones in green I'm going to be keeping and buying more of. The ones in red I'm going to be selling, and the ones in blue I'm going to be keeping but not necessarily adding. US equity, I've got a lot of it in my portfolio, so due to the poor performance in 2025, I will not be adding more. I will instead invest in the S&P 500. It's obvious why I've sold FTSE 250, Target Retirement, and Pacific ex Japan, and Life Strategy. The All World High Dividend Yield has also got high charges, so it's also rationalizing the performance, the charges, and thinking also about the latest performance in 2025. But as you know, this past performance will not be indicative of what's to happen in the future. Again, so the lessons are: 1, if you're investing for yourself, you do need to read a little bit, think about your investments, but think about annual reviews to see how they're performing. And the second thing is contact a financial advisor should you wish to. The third thing is that think about diversifying your portfolios. If you are going to be a lazy investor and just putting money, for example, in the S&P 500 or the US equity, you will know that you're very hyper concentrated in one geographical region, which puts some elements of risk and the risk of poor returns. Again, equally, you can't put all your money in emerging markets and Asia, because again, there is some volatility within those markets. So I hope you've enjoyed this video. Please let us know what has surprised you and what do you think you want to buy, what do you want to keep, and what do you want to sell based on this information if you have similar funds. Again, see you in our next video.